we go. Okay, so we're going to go over these terms, acronyms, and formulas. And we're just going to start with some real basic ones. Deed. What is a deed? There's an example of a deed right there. In North Carolina, you generally have several types of deed: warranty, non-warranty, quick claim, trustees, and special warranty deed. Doesn't really matter the distinction between all of those. That's mostly a matter for your attorney. But what you do need to know is a deed is a document that conveys ownership of property. It is your title, more or less, to the property. It is your proof of ownership, and it gets recorded at the Register of Deeds through your closing attorney. On the other hand, a deed of trust, which many people confuse, does not convey ownership. And the reason it's confusing is because, of course, it has the word deed in it. But a deed of trust is what's known in other states as a mortgage. They are the same thing at the end of the day. There are some technical legal differences in how they achieve their end goal, but both of their end result is that it is a document that allows your lender to take back the property by a process called foreclosure if you do not make your payments. It is also recorded at the Register of Deeds, just like your deed. If you buy a property, they'll record your deed first, and so 1 second later, they'll record your deed of trust. If they record them accidentally out of order, the deed of trust is no good because you can't give it unless you own it. So it is a security interest. It secures the bank's interest in the property. And the document that mortgage or deed of trust secures is called a promissory note. This is not recorded. This is a private contract. It's governed by contract law. It's a contract where you agree to pay your lender a specified amount of money. If there were no deed of trust, then a promissory note, if you didn't pay, the lender's recourse is to sue you in a court of law. So it's just a contract action. They sue you for breach of contract. And even if they win, that's not much of a victory, because then they would have to go try to collect from you. What the deed of trust does, it secures that promissory note by allowing the lender to foreclose and take the house back to secure the obligation of the promissory note. Therefore, lenders don't have to, engage in the process of court, a year-long court battle to get their money. They probably, wouldn't. Home loans would not be as common without the security document. Okay, so those are your three main documents when you buy a house. I've mentioned the Register of Deeds. In North Carolina, there's a Register of Deeds in each county, and some states have their recordings at different offices. In North Carolina, it is the Register of Deeds. They record documents such as real estate, marriage, death certificate, all kinds of stuff. And then you have a clerk of court. They also file documents, and sometimes people get those confused. The clerk of court is where we file documents such as liens, civil and criminal lawsuits, evictions, criminal cases, stuff like that. Okay, so that's an overview of the documents involved with buying a property. Before we move on, does anyone have any questions about these terms that we just went over? Pretty simple, right? These are the basics. Okay. Karen, I can't see the chat with my share.
I got yeah,
okay.
I'm looking at, there's none.
Yeah, if you guys have questions, Karen will be monitoring the chat. Excuse me. Okay, next, due diligence. This is another term used when you are attempting to buy a property. In North Carolina, now, not every state has this. So if you're new to the state, this might be new to you. And in fact, it is new within the last, 5 or 7 years anyway. It is an actual payment for the privilege of taking the property off the market while you look at it. So you pay due diligence money and you decide not to buy it. Or let's say you pay your due diligence and you do your due diligence inspection, and you come back and ask the seller if they'll replace the roof. And the seller says no. Your choice now is to continue to buy or to forfeit your due diligence money. So as a result of that, during the very, very hot market that we had a year ago, due diligence became a bargaining tool. It was not uncommon to get due diligence of $50,000 and up. Why? Because if you're looking at two offers, and let's say they're both the same price, and one of them has 10,000 due diligence or 5,000, and one of them has 50,000, you're going to take that $50,000 due diligence, because there's very little chance that buyer is going to walk away. Because if they do, they're gonna lose $50,000. So you can be pretty sure that sale is gonna go through, no matter what they ask you to do. You can say, nope, 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 not doing anything, and they're probably not gonna walk away. Now, it's back to normal now, the market is, and we're not seeing that used so much as a tool, but it certainly was. Due diligence is non-refundable, and then, but it is applied to the purchase price, so you're not paying an extra 50,000 for the property when you close. I even saw one where the due diligence was the entire purchase price, so you knew that, you knew they weren't walking away. Okay, so then we have EMD, that's earnest money deposit. This is another fee paid when negotiating for the sale of a property. And this is a payment to secure the property until closing. It is also applied to the purchase price, and it may be refundable in certain cases. Earnest money is usually if, for example, if you have due diligence requests and the seller declines to perform them, you do get your earnest money back. And if the seller breaches in any way, you get your earnest money back, or can't deliver clean title, you get your earnest money back. If you, by the way, if the seller can't deliver clean title, you would get your due diligence back as well. But if you, the buyer, change your mind, then it is forfeited to the seller, and that's sort of a fee for, having the property off the market all that time up until closing. Okay, consideration is another term. Every contract must have consideration. This is not unique to real estate. If I contract to sell Karen a motorcycle, then there has to be consideration. There's some monetary exchange normally. If a contract does not have consideration, that is not valid. This is the reason you hear some new wholesalers who don't know what they're doing and don't put down any kind of deposit, often will have their contracts fail for lack of consideration. And in real estate contracts, the earnest money is the consideration. And I've argued in court before that the consideration is also a promise to pay, but we don't really know if that's true or not. Okay, so these are 3 contract terms used in negotiating purchase contracts. Any question on any of these before I move on to the next sort of group?
Not so far in the chat.
Okay.
Yes.
Now we're talking about some different kinds of real estate.
Oh, wait a
trends.
minute. I'm sorry,
Nope,
Kathy.
nope,
Somebody
nope.
raised their hand. If you can, put it in the chat. It's hard to see when you raise your hand because we don't have but so many of you on a screen.
Yeah.
But
that's
Sarah,
true.
go ahead.
Hey, Kathy, so back to your comment on due diligence and those other types of fees. When I go to another state outside of North Carolina, where do I need to go, say, for example, in Arkansas, to look to see if they require due diligence? What department within the government do I?
Well, it's not a government department. The most common place would be a realtor who would have the realtor form contract, or an attorney.
Okay.
In North Carolina, so and that's a good question. Let me address that for a minute. It's not the law. If you called around North Carolina, there's no law to tell you have to have due diligence. What it is, it's been made part of the standard purchase contract, which all realtors use, and so it's the joint bar realtor form. If you and I are doing a private transaction, there's no law that says we have to do due diligence. And in fact, many off-market deals do not do due diligence. So it's not a law. It's more of a common practice. In North Carolina, you would be hard pressed to okay, Bonita, the difference between due diligence and earnest money is the due diligence, and that's a really important distinction. The due diligence, you are actually paying to take the it's for the privilege of inspecting the property. You're paying for the privilege of being sort of first in line to buy, whereas earnest money secures the transaction. It's the consideration. Due diligence is just really a fee. The due diligence is paid directly to the seller up front, and they get to go spend it. The earnest money is held in escrow with the realtor or the attorney. Hopefully that clears that up.
Yep, and that's all. I thought
Okay.
both can be refundable per contingencies.
Wait, what's that?
She's saying I thought both can be refunded per contingency.
I don't know what that means, Benita. but due diligence, there would be no point in having both if they're both refundable. The sole
Right.
purpose of due diligence is that you have the privilege of inspecting that property. Hope that makes sense. Okay, different kinds of real estate deals, wholesale. Wholesalers, if you hear that term thrown around a lot, what they do is they don't buy houses. They get a property under contract, they find a buyer, they assign the contract, and there's several ways to do that. One way is they just get, excuse me, they assign their contract to an end buyer in exchange for an assignment fee. And that is just an assignment fee that'll be paid as a line item on the closing statement. In some cases, the wholesaler actually has to close. In those cases, they do what's called double close, where they will buy and sell in the same day. In this current regulatory climate, we used to have mechanisms where we could do that, where the wholesaler wouldn't actually have to bring funds to the table. That is no longer the case. There is funding available for that, and that's one of the terms we'll look at later. Wholesaling, a lot of people get into it when they first start as new investors because it's something you can do without loans or money. You don't need really any money to do it. And I think it's easy. It is a good starting point if you just want to get some money and you don't have money, but it is not a good starting point if you think it's easy, because indeed, to be a wholesaler, you have to understand all aspects of investing, including ARV, cost of repairs. And if you don't know those terms, we're getting to them. So you really have to know all those things in order to know how to price how to A, make your offer, and B, how to price the property. So if you don't understand how to do all of those things, you're not going to be a successful wholesaler, because you won't know how much you can pay for it, and you won't know how much you can sell it for, and what fee you can make in between. So while it is a good starter for some reasons, it is by no means because you don't know what you're doing.
Yeah.
And sometimes,
Kathie,
yeah.
someone has said, please re-explain the double close.
A double close is when you buy and sell on the same day. Okay, then we have wholesale. That's a combination of wholesaling and a full fix and flip rehab. So you sort of buy the property at a discount as if you're going to wholesale it, get it under contract, and you might fix up just a couple things, and then you just turn around and sell it. They call that wholetailing. And then we have, sorry, my Zoom thing's getting in the way of my slide. Then we have fix and flip, of course. And that is where you buy the property, you fix it up, and you sell it. Again, you must know the cost of repairs. You must know ARV in order to know what you can pay for it and what you can sell it for. And again, we will define those terms as well as the formulas here in a minute. BRRRR, this stands for buy, rehab, rent, refinance, and repeat. It's a funding strategy. Buy a property, you fix it up, you rent it out, then you go refinance it and pull all your money out of it, and then you repeat that. So you just keep going and going, and each time you pull your money out, and then you have the funds to buy another property. And that is the BRRRR method of investing. Okay, now the things we just went over: BRRRR, fix and flip, wholesale. Those are ways of investing. So any question on those?
Kathie, we've got a question. Wouldn't a wholesaler need a title company or attorney for the closing?
If they do a double closing, yes. In any event, yes. But mostly, Cynthia, a wholesaler does not buy. If they're doing a double close, yes, they buy. And yes, they do that with a closing attorney. If they're assigning their contract, they don't need a closing attorney. What happens is, I'll just give you an example. Cynthia, you have a property for sale and you're asking $100,000. I do my due diligence and I figure that that property is worth about $200,000 and it needs about $20,000 of repairs. So if I can buy it for you for 100, sorry, and I know it's worth 2. I, as a wholesaler, then have to figure out what can I sell it for so that my rehab buyer can still make money. I know it needs 20 in repairs. So I would add $10,000 on. I would buy from you for 100. I would sell it to Karen for 110. Okay. Karen would spend 20 fixing it up. So Karen would now have 130 in it, and then Karen would sell it for 200. Now, the two ways to do that: one, I can buy it and sell it to Karen on the same day at the same table with the same closing attorney. Number two, I assign my contract to Karen, which means I make an assignment agreement. It says, Karen, you will take over my contract to buy this from the seller for $100,000. In exchange, you will pay me $10,000. In that case, Karen needs the closing attorney, and Karen will go to the closing attorney with Cynthia as the seller and Karen as the buyer. And Karen will pay Cynthia $100,000, and on the closing statement, there will be a fee to me, the wholesaler, for $10,000. So yes, you always need a closing attorney. Okay,
And
now we're
so-
moving on to some.
Well,
fun-
there's one more. It says question. Yes, Sarah, don't know what you mean.
Yeah, so back to the double close question. What I thought I heard you say is the wholesaler, I didn't catch the bit about the wholesaler, that person themselves doing the double sale or double close.
Well, if I'm a
and bringing
wholesaler,
money and bringing money to the table. So
if I'm a
was
wholesaler, for sometimes, for various reasons, you may not be able to assign your contract. Sometimes it's just not possible. There are a variety of reasons for that. Sometimes you don't know want the seller to know what you're making, although for $10,000, that probably wouldn't be the case. Sometimes the loan that your end buyer is getting necessitates that you have ownership. Whatever the reason, if you have to do a double close, you will go to your closing attorney, you will buy it with funds, and then you will sell it 5 minutes later, and then you will make your $10,000 that way. That's a
Okay.
double close.
Okay, great. Thank you.
Sure. All right. So transactional funding, and that's a really good place for this slide. That's the funding you would use to do that. Okay. If you're a wholesaler and for whatever reason you need to do a double close, transactional funding is essentially a one-day loan. There are tons of companies out there who do this. They almost all charge 1%. So if you find someone charging more, keep looking. When you can't assign the contract and you have to buy and close on the same day, they will lend you the money. If they lend you $100,000, you would get their excuse me, in the scenario that I just described. If you borrow $100,000, so I'm buying from Cynthia for $100,000, I have to do a double close. And so I go to the closing table, and Cynthia, a transactional lender lends me $100,000, which gets paid to Cynthia. Then I, 5 minutes later, sell to Karen for $110,000. At that closing, I get paid $110,000. I pay off my transactional lender of $101,000. It's 1%. And there are plenty of lenders who will do that. So if you are a wholesaler and you get into a situation where you need to do a double close, obviously wholesale assignment is preferred, right? Because there's none of that, no fee. So you just assign the contract and you just get your $10,000. But if you have to, it's going to be 1%, and it is possible to do. Okay, then we have rehab loans, otherwise known as fix and flip loans. These are short-term loans. They are usually 6 months. There are some that go up to a year, some are 3 months, and they're higher interest. Right now, they're about 8 to 15%, depending on the lender. If you get a true hard money private lender, it's someone you meet at your RIA who lends money, you're going to be on the higher side of that. If you go with an institutional hard money lender, you'll be on the lower end. Part of it also depends on your experience level. If you are doing your first flip, there's plenty of lenders out there who will lend to you, but you're going to pay the higher interest until they form a relationship with you. On the other hand, if you've done 50 rehabs, you're going to be on their lower end. They also charge points in addition to that high interest, and generally they will loan you the purchase price, 80 up to excuse me, 80% of the ARV and 100% of rehab funds. So they vary. I've seen some go as high as 90. I've seen some at 70. There is one lender who purports to give you 100% of everything, up to, so it's not guaranteed. But there's one lender I know of, and there's probably more out there, just one that I know of, one of our vendors who purports to give you 100% of the purchase price and 100% of the rehab funds. But I think in their case, it's up to 75% of ARV. So If you are buying $100,000 property, it needs $20,000 in repairs. As long as they will loan you that whole $100,000, as long as it appraises for enough where that $100,000 is only 75% of the after repaired value. So it would have to appraise at, I don't know, I'm not too good at math in my head, but yeah, I don't know. So whatever is 100,000 is 75% of, it would have to appraise for that. Okay. And then again, the different iterations of them are just different depending on lenders. All of the institutional ones have draws. So you don't just get all the rehab money up front. You have to call for an inspection. And some of those lenders don't come out to inspect. They just have you send pictures. One that I've used literally just has you snap pictures. Another one that I use a lot has a program that it's an app that they email you. And on that one, it's like, it tracks the location. So you can't be shady and, go, if you said you hung all your mirrors, but maybe you didn't get them all up yet and you want them in your draw, you can't go take pictures of mirrors at another house because it actually tracks the location. And then, so they do an inspection either by just photos or sending someone out there. And then they give you your draw. Some of the true private hard money lenders don't bother with that because they're just one person. And so they'll just send you all the money up front. So there's a wide range of how to do these different kinds of loans. Okay, so those are kinds of loans. Any questions on those? Probably not.
Nope.
Yeah, okay. So STR is a short-term rental. What is a short-term rental? It's a vacation rental. You can hear it called vacation rental, Airbnb, Verbo. This is the home is furnished and self-contained. It can be a condominium, a home, a cottage, whatever. Airbnb is a common example. And that is as opposed to an LTR, which is long-term rental. And that's where you have a tenant with a lease, usually a year. Although it can be more and it can be less. A long-term rental is generally not furnished. With a short-term rental, you generally pay Wi-Fi, electric, water, lawn care. With a long-term rental, it's negotiable whether you or the tenant pays those things. Now, I don't think I have a slide for this, but one thing, there's also MTR, which is midterm rental, obviously in between short-term and long-term. Those are commonly, there's a site called furnishedfinders.com. That's the most common site to use for midterm rentals. Like short-term rentals, midterm rentals are furnished. Like long-term rentals, midterm rentals have a lease. It just depends on the number of months that they want to stay. Usually from 1 to 9 months is pretty common. And a lot of this is what you hear about traveling nurses, but it's certainly not limited to that. It can be people who are having a house built and had to, sold their house and had to move, or any kind of situation like that. Different traveling professionals, not just nurses, but traveling nurses is a real common one. Okay. Now we're going to move on to some more technical terms. Equity. Equity is the difference between the value of the property and what you owe. So that's pretty simple. If you have a house that's worth $200,000 and you owe $150,000 on your mortgage, your equity is $50,000. The value of equity builds up gradually over time, obviously, as you pay down your mortgage every month, and depending on the market, the property appreciates. So equity is a very simple term. Cash flow. And this is the amount of money that you put in your pocket at the end of every month after you pay all your operating expenses, including your loan payments. Sometimes we have negative cash flows. And you would ask, why would you ever have a house that's negative cash flow? Well, it depends on your strategy as an investor. Some investors are more concerned about building equity, so they may agree to a property that is going to have a negative cash flow, at least for some time, because they know that there's something going on in the market and the property is going to appreciate. It's a long-term play. They're willing to come out of pocket something every month. They don't need income. When I was first investing in my younger days, I had W-9 job and I didn't really care about income. I tried never to have a negative cash flow, But I didn't care about cash flow, as long as my properties, stayed even, didn't cost me money, paid all the expenses. That was good with me. As I moved, further in life and changed strategies, I no longer do that, but I still have some of those properties, and now they do cash flow. And now, they've been paid off over 20 years and I owe very little on them and they're worth a lot. So that's the long game. So obviously, if you spend less than you earn, that's positive cash flow. And if you're spending out of pocket more than you have coming in from rent income, then you have a negative cash flow. Pre-approval letter. This is a letter that you get from your lender, often before you even start looking for a property. And it's a valuable tool when making an offer, again, especially in a hot market like we had a year ago, that the seller can know that you're not just going out and starting the process, that some bank has already looked at you and said, yes, we would make a loan to this person. Appreciation. This is the increase in the value of a property over time. The reason for an increase in value is a number of things such as inflation, demand, or weakening supply. Again, we all had a perfect example of this last year when the market went nuts and all the values went crazy. The market has now adjusted and values are more in line. Although in North Carolina, we've been quite lucky that our values stayed pretty high. Other markets had a bigger adjustment, but we tend to think of appreciation as going up all the time, but in fact, it can adjust the other way. You can have negative appreciation in some circumstances. A hard money loan, we already discussed this a little bit earlier. And advantages of these is that they're typically quick to fund, but they have higher interest rates. And again, they can be private or institutional. DSCR, the acronym stands for debt service coverage ratio. With a DSCR loan, they don't care so much about your personal credit score. Some of them do still have minimums, but they're generally pretty low. They do care about your experience level. Again, it's not that they may not make you the loan if you are new. Some will and some won't. But you're going to have a higher interest rate until you build up some credibility and some relationship with the lender. They look at the capacity to repay the debt from net operating income, NOI. I'm going to define that in a minute. Generated by the asset. So basically, they look at what you can make in rent, and then taxes and insurance and all that stuff, and say basically, will this property make income? And if it will, they'll make you the loan. So if it makes enough to cover the mortgage, then you're usually pretty good to get the loan. So lenders evaluate the debt service coverage. And that's one indicator that they use to calculate the minimum amount that they would loan. So they'll run their numbers and they'll say, for this property, we will loan you X amount of money. And how do you figure it? The debt service coverage ratio is the net operating income divided by the debt payment. And then you can't really, a common question is, well, what does that number have to be for a lender to make a loan? The answer to that is every lender is different. They all have their own criteria. The lenders who make these loans are not your conventional mortgage lenders. In fact, there's some unique things for hard money loans, DSCR loans. They don't have to be licensed as a mortgage broker. And furthermore, they cannot loan to you personally. They can only loan to your entity. So you have to set up an entity, which I'm sure you have as a real estate investor already. And they can't make these loans for a house that you will live in. They're only for an investment asset. So for that reason, they're not subject to all those safeguards that they have for homeowners, who may be buying a new home for the first time. They assume you're an experienced investor. So your lenders do not have to be licensed, and they do not have to follow those rules and regulations for primary home lenders. Okay, what is ARV? ARV is after repair value. How do you figure ARV? Well, there's a lot of classes, and we have a lot of, we'll have that as a topic on our subgroups from time to time. We have classes on it. Jackie runs some really good workshops on it. But if you want just an easy way to do it, it is done by looking at comps. What is a comp? A comparable sale in the area. So generally, you're gonna look within a 5-mile radius, within a 6-month time frame. But it's not all that easy. So one way to do it is county tax site. Some county tax sites have really good sites for this. I know that Durham County is wonderful, and Mecklenburg County is wonderful. They have very robust tools where you can just go on their tax site, put in the address, and you can find a whole list of comps in the area. So that's one really good way. Another really good way is Zillow. And I do not mean going on Zillow and looking at the Zestimate. That is a bunch of bonk. Don't ever do that. But what you do is go to the map on Zillow, and there's a drop-down menu, and you can choose from for rent, for sale, sold. You want to choose sold. You want to hone in on your map within that 5-mile radius of your subject property. And then you want to look at every single house that has sold. You can, if you don't find a lot, you can look at what's for sale as a guide, but your real good true comp is not going to be what's for sale, because there's no proof that's going to sell. So your real good true comps are sales. You can do the same thing in the MLS. You can ask a realtor, and you can use platforms like Connected Investors. Now, it's not enough to just go hone in on your map, go your 5-mile radius, and look at all the sales. What I would suggest, if you're experienced, you can do this maybe in your head. If you're new at it, I would suggest making a spreadsheet. On that spreadsheet, put your property, put how many square feet it is, how many bedrooms, how many baths, does it have a garage? Is it rehabbed, or is it not rehabbed? Okay, because you're looking for after repaired value. I mean, what is my property worth after I fix it up? Then all these, wherever you found your comps, whether it's the county tax site, Zillow, MLS, Connected Investors, whatever, you click on each one of those. You want to look at the square footage. How does it compare to yours? How do the bedroom baths compare to yours? Is there other distinguished features like a garage? And you make yourself a little spreadsheet, and then you come up with an average per square foot price. And when you've looked at the properties and how they compare to yours and the characteristics, number of beds, number of baths, other features, that is how you figure a good ARV in a nutshell. Again, that's a complicated topic. There's no way I can give you a comprehensive explanation of that here in this meeting today. There are other, classes, but that's the Reader's Digest version. Okay. Next. MAL, you hear this one a lot. What does that mean? Maximum allowable offer. What is it? It is simply the ARV times 70% minus repairs. Okay, so let's say I'm looking to buy that house from Cynthia that we talked about earlier. Her asking price is $100,000. So I go back here and I run my ARV like we just talked about, and I figure out that property's worth $150,000 after I get it all fixed up. I'm going to need $20,000 in repairs to do that. Okay, so I'm going to take that $150,000 times 70%. That's $105,000. I'm going to subtract the cost of my repairs, which is $20,000. That is $85,000. So Cynthia's asking price is 100. But my maximum allowable offer is 85. And so that means I'm going to offer her what? Not 85. I'm going to start at 75, because you never get it for what you ask for. And then she's going to come negotiate with me. But maximum that I'm going to go to offer on that $100,000 house is $85,000, because I know I've taken the ARV of 150 times 70% minus my 20,000 in repairs. That tells me what my maximum allowable offer is. Okay, debt to income ratio. This is a personal finance measure, and lenders use it to compare your monthly debt payments, what you're paying out every month, to your gross income. So lenders look at this, and they, again, I can't answer you the answer to the formula because lenders are all different. But they each have their methods or their number that they will accept. Your monthly debts are what percent of your monthly income. And if you meet that, that's another factor that they use in determining whether or not they will agree to make you a loan. this is not used in your DSCR loans or your hard money loans. This would be a more normal mortgage loan. Okay, cash on cash return. What is that? Cash on cash return is a comparison between the cash flow in 1 year. So really, when you hear cash on cash, that is just a year one term. That's your cash on cash for your first year. And that's relative to your initial investment of the property in year one. So the calculation is where the cash flow, you get your cash flow divided by how much you initially put in. That's your year one cash on cash return. Because what in your first year, so if your mortgage payments every year come up to be $50,000, well, your first year is different, right? Because you not only have your mortgage payments, you had points, down payment, you had more cash outlay in your year one. So the equation is your year one cash flow divided by your year one capital expenses. And there's an example there for you. If you initially put in a down payment, then you had a mortgage, you had your renovation costs and your brokerage fees, $10,000, and then it'll bring in $2,400 in annual cash flow. So that's property A. Property B has the same kind of investment, except it's $20,000 and it's going to bring in $3,600 of cash flow. So on first glance, you might think the second one seems better because it makes more cash flow. But when you compare it on cash return, the first example is 24% and the second is 18%. When you do that calculation, take the cash flow, divide by your capital expenses. So it's just a way of really drilling down and assessing your deal in a way that, allows you to analyze it better than just, oh, I'm going to make 2,400, I'm going to make 3,600. Sometimes 2,400 might actually be a better deal. Okay, again, this is only used in the first year. It's not a time value of money calculation. In order to calculate it out, then you have to adjust for time value of money. And when you get into the time value of money, you have tapped out on my expertise level, and it is definitely not within the realm of these basic terms. So that is when you're going to go talk to your accountant. And also it is affected by income taxes, and income taxes are affected by depreciation. So there's more to it than meets the eye. Again, that is a fact that I know, but it is out of my expertise in calculations. But you do have to be sure to calculate those non-cash expenses as well when you're figuring cash on cash return. NOI is net operating income, and that is where you take your total revenue from gross rents and you subtract all operating expenses. And these include everything: maintenance, allowance, you've had vacancies. But it also, does not include capital items like principal and interest payments and depreciation. So net operating income is different from cash flow, right? Because your cash flow is just basic, take what you brought in minus what you paid, that's your cash flow, but it's not your NOI. The equation here is your total revenue from gross rents minus your total operating expenses. But again, we're not putting in principal, interest, and depreciation. So net operating income is a different calculation and a much different result than your actual cash flow.
Kathie, you've got a question.
Okay.
Typically, there's a 20% down payment when buying a house. Is the down payment amount more than 20% for an investment property?
Good question. The answer is like any good lawyerly answer. It depends. Depends on your lender. Again, these lenders are all over the map. They all have their own thing. You just have to ask. I would say that overall 20% is very common. And in all of the DSCR loans I've ever done, which have been many, 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 certainly 20% is the average. However, again, one thing you need to understand as a new investor is you need to not form a relationship with just one lender. Because just like all the other things we teach you of having tools in your tool belt, it's no different with lenders because they all have something different. As I said before, we have one lender in our vendors that I know of who purports to offer 100%. So in that case, it's no money out of your pocket. Some will be, I've seen them as low as 70%. I've seen them at 90%. So it's all over the map. So, well, I would think, yes, I agree, 20% is probably pretty typical. It is strictly dependent on the lender. These guys are not subject to all those same regulations, so they can really do their own thing. So again, it's very, very important that you get to know them all. I actually have a spreadsheet that I keep every time I talk to a lender or work with a new lender. I add them on there and I wrote, what their fees are, and I write what their niche or whatever you want to call it is. Like, this one does 100% lending. This one will fund in 24 hours. Because if I find someone who's going to foreclosure sale tomorrow, I might need 24 hours and I might be willing to pay for that so I don't lose that property. On the other hand, if I'm in the middle of 3 deals and I find one I just can't pass up, I might be strapped for cash and I might need 100%. So they all have their own little idiosyncrasies and their own little benefits. You really need to get to know them all and make yourself a little spreadsheet so that when you need a loan, you can just go refer to that and go, oh, I'm gonna talk to this lender because I talked to him and this is his thing. It's just like knowing the tools in your tool belt. So it's a good question, unfortunately, to answer, but 20% is a good average. Okay, this is your cap rate, capitalization rate, otherwise known as cap rate. Whoops, sorry. This is a fairly quick and easy way to compare two rental properties. And so to calculate this, you have to, of course, estimate the net operating income, or if you're buying a property, you would look to what the seller has shown you as the net operating income. They will often provide actual numbers for you. If it's a new construction, then of course you would have to calculate it. And then you just divide that net operating income by the property value. It's that simple. So net operating income divided by the property value. And then there's always that question, well, what's a good cap rate? Well, that's when I first learned about cap rate, that was my big question. It's easy enough to calculate it. That's pretty simple. But when I did it, that number really meant nothing to me. And it's still elusive because honestly, there are several factors. And the main one is cap rates differ by geographical market. So my thing was, well, how do I know? If I'm looking at property out of state, how do I know what is a good cap rate in that market? The answer is you can ask, or I've done some internet searches where just go average cap rate in Austin, Texas, or something. You can find, information. So then you can see if your cap rate is in line. And the reasons for this are, pretty obvious, because obviously, I recently visited my son in Aspen, Colorado. Okay. Right across the street from where he lives, there's a shotgun house. Literally, if it was in the town of Pittsburgh, North Carolina, if it was in Raleigh, it'd probably be 250, maybe 300,000. If it's here in Pittsburgh, probably 200,000. If it was 20 minutes south of here in Sanford, it would probably be 185,000, right? So if you think it's weird that cap rates vary by market, all you have to do is think, well, duh, every market is, things are worth a different amount, things rent for a different amount. So it's an easy way to look at it. So, and they also differ at time period. So what's a good rate today might not be a good rate several years from now. So it really, although the cap rate is a super easy calculation, then my problem with cap rate has always been, okay, I got the cap rate, now what do I do with it, right? Because that's the actual harder part is figuring out if that's a good cap rate in your market. And obviously, if you work in the same market all the time, that's much easier because you'll have experience and you'll know what a cap rate is. But if you're looking at markets where you're not used to working in, the real work is figuring out what is a good cap rate. Okay, break-even ratio, or sometimes known as the break-even occupancy ratio. This is just you add up your operating expenses and mortgage expenses and divide by your projected yearly rental income. And that will tell you like what proportion of the property has to get rented out to break even, and it's in a multifamily situation, or what your vacancy, how much you have to be full to break even. So the equation is total operating expenses plus total debt service divided by your projected rental income. So the break-even ratio is, again, this is more used for multifamily. It's not as relevant for single family, but if you get into multifamily, you will probably know these numbers from your seller. You'll have the average vacancy ratio, and then you'll be able to get your projected rental income by looking at the historic records of the seller, and then from that you can calculate your break-even ratio. Price to rent ratio. This is the purchase price of the property divided by the amount of rent you expect to receive each year before expenses. Okay, so if you're comparing different properties, it might help you determine which one is better. You know, if you're looking at two properties, so the equation is you take the price of the property and divide by the rental revenue for the year. And then I have seen some people flip the ratio and call it rent to price over cost ratio. And then other people I've seen use the rental income from 1 month instead of a full year and do it as a monthly calculation. But either way, it doesn't matter which way you do it, as long as whatever method you use, you apply to both properties. So you're comparing apples to apples. And this is also sometimes called the gross rent multiplier. But price to rent ratio is, to me, a more clear term. But in case you've heard gross rent ratio, gross rent multiplier, that is the same thing as price to rent ratio. Loan to value ratio. This is to calculate the amount of debt you have relative to your property. Obviously on this one, it's easier to tell what's better. You don't need to be comparing two properties. It's simply the lower the ratio, the better means you have, excuse me, less debt relative to the asset. So the equation is outstanding debt divided by the value of your property. If I have a property that is worth $300,000 and I owe $250,000 on it, and it's worth $300,000, my loan to value ratio is 83%. Obviously, the lower you go, the better you are, the more equity you have in the property. It again decreases in one of two ways, and not really one of two ways, often both of these ways at the same time. One, you pay down the debt, that makes it go up, and two, the property value goes up. Well, mostly those things are happening at the same time. So loan to value ratio obviously changes the more you pay down the debt in the market. And if you have some kind of 2008 event, then it could go the other way, because the value of your property might decrease. Okay, ROI, return on investment. This is also known as the internal rate of return. So if you heard any of those three terms, sorry, they mean the same thing. Okay, this is gosh, sorry. It's closely related to the net present value of real estate that we just discussed. It is also the most complicated calculation in my mind. That's why I put it as my last slide. Whereas cash on cash return and equity calculations are useful only in the first year, this calculation considers the time value of money. Remember, I told you, when you get into time value of money, you're in way above my level of expertise. So I can't even do that. So don't ask me any questions about this formula, because basically what I'm telling you about it here is all I know about it. But the thing that makes it useful is it's useful in any year, not just that first year. And so this is your annualized rate of return. So the equation is right there. You can read it. Yeah, you see why I don't want to explain it anymore. But you see, so when we get into the one internal rate of return and then the two, that's where they're calculating the time value of money. So how are these related? The net present value, I don't know where we went. Net present value, I don't remember where it was. And return on investment. Sorry, this thing's in my way. They're related because the same discount rate that causes the net present value to equal 0, this will be the internal rate of return solution. So in other words, IRR equals the discount rate that makes the net present value 0. Again, this is complicated, and there are, rather than trying to understand it, which to me, there are probably people on this call who understand this. I'm not one of them. And in fact, I don't want to understand it because they have rental property calculators and you can use them. I had a link here, but I don't know if it's working. Is my screen changing? Do you guys see this? Or is it still on the slide?
Still on the same slide.
Okay, so what I'm going to do is, instead of trying to show you this, so when I click that link that I put in there, it takes me to this calculator, but it's not showing it to you guys. So what I'm going to do is just put this link in the chat. And that's a rental property calculator. For my money, I will just go use that and plug in what they asked for instead of ever trying to figure that dang thing out. But you know, it is something you'll hear of, and so I didn't want to put it. And the most important distinction is that it does take into account that present and future value of money, and it also can be used against different asset classes, like not just real estate. So you do with that what you will. So that's I'm going to end on that note and see if there are any questions.
So I think you answered Sarah's question. She was asking for the formula for the IRR, but I think the calculator will take care of that.
Yeah, well, the formula is right there if you
Yeah.
want it. If you
Yeah,
want it,
I
if you want
actually
it.
just saw it.
If
actually
you
saw
are
it.
a sucker for punishment, you go right ahead and take that formula. But
Yeah.
again, for my money, I would use the calculator, that link that I put in there. That's a good.
I actually happen to be one of the people who does understand that flow.
Okay, yay for you.
Yeah.
Not me. But yeah, okay, so that formula will be useful for people whose brains work that way. I am not that brain of a
Yeah.
person.
So Kathie, there are no more in the chat. That's it.
All right, unless
You explained it all.
anyone has any questions, then we're gonna let you go. And unless anyone who has joined who wanted to say anything who didn't get a chance to at the beginning, feel free to unmute. Otherwise, I will say it once again, for those who didn't hear or may have come on late, the recording of this meeting will be loaded to the calendar by this time tomorrow. The way you get it is you go to the calendar, you click on this meeting, you scroll down, and it'll be on the bottom right-hand side. You can only access it if you are attended. So if you were checked in and registered and attended, you can access it. No one else can. So that's all I got, guys. Any other questions? Anyone else want to speak up or introduce yourself? Okay.
So I actually,
Yep.
excuse me, how are y'all? I tried to turn the video back on so it could show my face, but how y'all doing today?
Hi.
How are you?
Hey, how you guys doing today? I'm sorry.
That's all right. How are
So
you?
my question, it was on the maximum allowable offer. So with the hard money lending situation, and as you went through it, you were saying there are some lenders that will lend the full amount of the repair costs. So my question was, does that change the maximum allowable offer that you can offer if the repair costs isn't actually in the full loan?
Well, okay, that's a good question. The answer, I think, for most people would be no, it does not change it because maximum allowable offer is not a loan term, it is a profit term. So
Right.
maximum allowable offer means this is the most I'm going to offer because this is how I want to make. Now, and again, it'll depend on what your end goal is. If you are a wholesaler, okay,
Right.
and let's just make up some numbers. Let's say we have a property that's where ARV is worth $200,000. Okay, it is being offered for sale for $100,000 and you know it needs $20,000 in repairs, right?
Right.
So at $200,000 ARV, you're gonna take that times 70%, and that's $140,000. You know
Right.
it needs 120,000 in repairs, so you're gonna subtract $20,000. Okay, your maximum allowable offer is 120. So if it's being offered for 100, that's a good deal. You can offer that. And they'll, now, let's say you're a wholesaler. So you're a wholesaler and you pay 100,000 for this property. You know it's worth 200 ARV, and you know it needs 20 in repairs. Now you, as the wholesaler, have to go find a buyer who can still make money on it. So that's really where MAO comes in. You're factoring everybody who needs to make a profit. So you buy it for 100, maybe you take an assignment fee of 10. So your end buyer ends up buying it for 110, you buy it for 100, or they buy it for 100 from the seller, and they pay you a $10,000 assignment fee. So they're in for 110, they put 20,000 in repairs. Now they can sell it for 200,000, which is $70,000 profit, which is pretty good.
Okay.
Now, if you're the end wholesaler, if you're gonna buy and keep that property, okay, let's look at the same calculation. But a different scenario. You buy it for $100,000. You put 120 in it. Now, sorry, you put 20 in it. So now you're in for 120. You do your repairs. You can sell it for 200, and then you have an $80,000 margin. Also very good. But so you might think to yourself, as a wholesaler, I definitely need to stick with MAO. As a rehabber, maybe I can deviate from it, but I don't necessarily recommend it. And here's why. Because 80,000 sounds like a good profit, and it is a good profit. But as a person who's been rehabbing for many, many years, I can tell you that, often you will have surprises. And maybe that 20,000 turns into 40. Maybe the market tanks and it's harder to get offers by the time you're done. Because of the number of things that can happen, MAO is going to be a safe number for you.
Right.
Many wholesalers will take MAO and then deduct, their wholesale fee and offer even lower. And then a third way to look at it is the exact same scenario, but now you're a landlord. Okay, you're going to buy that property and you're going to rent it out. Well, in that case, then maybe your MAO is something very different, because if I'm a landlord and I pay 100 and I do 20 in repairs, now I'm not trying to sell it. I'm going to look at some different calculations. So I might look at, what I'm going to get in rent. I'll do some of these other calculations. I might not care so much about maximum allowable offer. So the answer is, it depends on your end strategy. For a rehabber, MAO is a very safe offer. For a wholesaler, it's safe depending on your wholesale fee. If you want a larger wholesale fee, you might move that number even lower. And then for a landlord, it's a different whole calculation.
Right. It changes based off of what you're trying to do.
Based off,
I appreciate
exactly.
you, Kathie. Thank you.
You are very welcome.
Yes, ma'am.
Anyone else? Okay. Thank you all so much for being here. I enjoyed it, and the recording will be up tomorrow, and we got you off before 7:30. So I hope y'all have a great night.
Have a great
Night.
one. Thank y'all again. I
you.
appreciate y'all.
Our pleasure.
Bye.
Thank you for being here. Bye-bye.
Good night.
Have a good night. Let me see.